and welcome to the briefing for March year-end reporters. The full accounting reminders are available on Viewpoint, but over the next few minutes I will explain the key issues for each topic. If you want to jump to a particular section, the timestamps are on the screen now. In the last few months, the FRC have released their annual review of corporate reporting as well as 4 thematic reviews. In September, a follow-up thematic on IFRS 15 was released, as well as a review of IFRS 16 disclosures in the first year of application. In November, a thematic on cash flow and liquidity was released, which includes a useful summary of cash flow statement errors requiring restatement following review by the FRC's corporate reporting team, which I'd really encourage all preparers of cash flow statements to have a look at. In November, the FRC also issued a substantial thematic on climate change. This consisted of a suite of reports looking at all aspects of climate change reporting and auditing, including the role of boards, companies, auditors, professional associations and investors in considering and responding to climate-related issues, concluding that all parties need to do more. In addition to this, in November the FCA announced that for periods beginning 1st of January 2021, premium listed issuers in the UK will be required to report on the Task Force on Climate-Related Financial Disclosures framework on a comply or explain basis. On to Brexit. For some entities, the implementation period completion date on the 31st of December and the EU-UK Trade and Cooperation Agreement, agreed on 24th of December, might introduce additional risks that should be factored into reporting. An additional consideration is that there was a change in tax status when the implementation period ended on the 31st of December 2020. Various tax exemptions and reliefs arising from EU membership no longer apply to UK companies, and in some cases to other EU companies transacting with the UK. Therefore, it is important to identify these exposures and consider the tax accounting consequences. Changes have also been made to UK company law as it applies to corporate reporting in order to address issues arising from the UK's exit from the EU, with some important changes to exceptions and exemptions that will be relevant for some companies. For companies reporting in compliance with the UK Companies Act, reporters will need to change how they refer to the IFRS-based framework they have applied in certain sets of financial statements. For periods beginning on or after the 1st of January 2021, UK companies using IFRS will apply UK-adopted IFRS. However, there are transitional rules that will impact financial statements for periods beginning on or before the 31st of December 2020, but which are signed after the 31st of December 2020. These changes therefore impact 31st of March 2021 year ends. The IASB have issued an IFRS 16 amendment which provides an optional practical expedient if certain conditions are met for lessees from assessing whether a rent concession related to COVID-19 is a lease modification. Lessees can elect to account for such rent concessions in the same way as they would if they were not lease modifications. In many cases, this will result in accounting for the concession as a variable lease payment in the period or periods in which the event or condition that triggers the reduced payment occurs. For UK entities, there has also been an amendment to IFRS 102, which differs from the amendment to IFRS 16, setting out clear requirements for recognising changes in operating lease payments arising from COVID-19 related rent concessions on a systematic basis over the periods the change in lease payments is intended to compensate. From a front half perspective, there are a couple of new regulatory requirements. Firstly, changes to streamlined energy and carbon reporting will impact quoted companies, large private companies and large LLPs. Secondly, the implementation of the revised EU Shareholder Rights Directive in the UK has resulted in a limited number of changes for quoted companies to the rules around the approval of the remuneration policy. In particular, for policies taking effect on or after 10th of June 2019, it is no longer possible to seek shareholder approval of a one-off payment. Companies must seek approval for an amendment to the policy. There are also a number of changes to the requirements around the disclosure of the policy, though UK market practice means that many quoted companies have already adopted these. In respect of pension accounting, there have been 2 new developments. The first is that on Friday the 20th of November, the High Court handed down its judgment in the latest instalment of the Lloyds Guaranteed Minimum Pensions Equalisation case. It concluded that schemes will need to consider whether to review past transfer values, potentially going back 30 years, and determine whether these need to be topped up. The second is that on the 25th of November, HM Treasury and the UK Statistics Authority released their joint response to the consultation on the reform to RPI methodology, and specifically the proposal to align RPI with CPIH from 2030 or possibly as early as 2025. Companies will need to consider how to set both their RPI and CPI inflation assumptions in light of the announcement, as generally CPI is almost 1% lower a year. On to IBOR reform. Since the financial crisis, the replacement of interbank benchmark offered rates, known as IBORs, has become a priority for global regulators. This is an ongoing process and is happening at different speeds in different parts of the world, but is expected to happen by about 2021 or 2022 in most parts of the world. The IASB has released 2 phases of amendments to give reliefs from the effects of IBOR reform. Given the pervasive nature of IBOR-based contracts, the reliefs could affect companies in all industries. The Phase 1 amendments, issued in September 2019, cover amendments to IFRS 9, IAS 39 and IFRS 7 that provide temporary relief from applying specific hedge accounting requirements to hedging relationships directly affected by IBOR reform. These amendments are mandatory and should be applied for annual periods beginning on or after the 1st of January 2020, with earlier application permitted. The Phase 2 amendments, issued in August this year, cover amendments to IFRS 9, IAS 39, IFRS 7, IFRS 4 and IFRS 16 that address issues that arise during the reform of an interest rate benchmark, including the replacement of one benchmark with an alternative. These amendments are effective for annual periods beginning on or after the 1st of January 2021, with early application permitted. Accounting correctly for supplier financing arrangements has attracted significant attention from regulators since the failure of Carillion, with focus, amongst other areas, on a company's source of finances. This includes whether a company has made material use of supplier finance arrangements, if this is transparent from the annual report, whether the related balances are appropriately presented as bank debt or trade creditors, and whether subsequent cash flows are appropriately presented. In the UK, the regulator has indicated it expects better disclosures around supplier financing arrangements than companies are currently providing. The accounting for supplier finance arrangements will depend on the exact facts and circumstances relating to them. We continue to see a large number of questions on the restructuring of issued debt instruments, for example loan facilities or bond financing, and modification of derivatives to take advantage of low interest rates. This is a complex area of accounting which can require significant judgment. To assist companies in understanding the potential issues, some of the key accounting considerations under IAS 39 and IFRS 9 are summarised in our accounting reminders. These include determining whether the new and old debt have substantially different terms, the treatment of a gain or loss on modification or extinguishment of the debt, the treatment of fees incurred as part of the renegotiation, the use of an intermediary, and the modification of derivatives. In January, the IASB issued educational material to remind entities preparing financial statements in this difficult environment on what needs to be considered when providing the going concern disclosure required by IAS 1. The document focuses on judgmental areas where there are significant doubts over going concern, but where mitigating actions are sufficient for going concern to be appropriate. Where material uncertainties remain, it highlights the need to disclose the uncertainties, as well as information about the judgments made to conclude that going concern is appropriate. Reference is also made to the agenda decision in 2014, which concludes that when mitigating factors are in place, and it has been concluded that there are no material uncertainties, such conclusions would involve significant judgment requiring disclosure under IAS 1.